How could a handful of bad mortgages in the suburbs collapse the global economy? This is the story of the 2008 financial crisis, a meltdown triggered by greed, denial, and dangerous illusions, and how its shockwaves still shape our lives today. Before the collapse came the boom, and it looked unstoppable. The early 2000s were full of optimism. The dot-com bubble had burst, but America bounced back. Interest rates were low, credit was cheap, and the housing market was on fire. Buying a home wasn't just the American dream, it was the American investment strategy. Home values kept rising, families felt richer, banks felt confident, and Wall Street saw an opportunity. The logic was simple. If prices always go up, why not lend to everyone? So banks did just that. They handed out mortgages to almost anyone, even people with no steady income, no savings, and no credit history. These were called subprime loans, high risk, high reward. But on paper, they looked profitable because the banks didn't hold the risk, they sold it. They bundled thousands of these risky loans into financial products called mortgage-backed securities, then sold them to investors around the world. Pension funds, insurance companies, even foreign governments. Everyone wanted a piece. Because these securities had one big promise: safe, steady returns, backed by American homes. To make it even better, or worse, Wall Street added another layer: collateralized debt obligations, or CDOs, a mix of different loans, sliced and repackaged again. It was complex, confusing, and completely detached from reality. But the money was pouring in. From 2001 to 2006, U.S. home prices surged more than 60%. Construction boomed, real estate shows filled TV screens, and ordinary Americans bought second homes just to flip them for profit. It felt like a new kind of gold rush. And just like every gold rush, greed came first. Then came the cracks. And if you appreciate stories that connect the past to the present, don't forget to like the video and subscribe to the channel. It really helps us grow and brings more stories like this to life. The cracks started in 2006. Home prices stopped rising. Then they started falling. Suddenly, those safe investments didn't look so safe. People defaulted on their loans, foreclosures spiked, and the value of mortgage-backed securities collapsed. Investors panicked. But the banks? They were in too deep. Big names like Lehman Brothers, Bear Stearns, and Merrill Lynch had billions tied up in toxic assets. Assets no one wanted anymore. And because no one really understood how much bad debt was hidden in the system, everyone stopped trusting everyone. Banks stopped lending to each other. Credit markets froze. Liquidity dried up overnight. It was like oxygen vanishing from the financial system. Then came the real shock. March 2008, Bear Stearns, once a Wall Street titan, collapsed. It was sold to J.P. Morgan Chase for just $2 a share, with government help. That should have been the wake-up call. But worse was coming. September 15, 2008, Lehman Brothers filed for bankruptcy. No bailout, no rescue, just collapse. It was the largest bankruptcy in U.S. history. Over $600 billion in assets, gone. And it sent a message: no one was too big to fail. The stock market crashed. In just 6 weeks, the Dow Jones lost 30% of its value. Retirement accounts vanished. Home values plummeted. Millions of jobs were on the line. And around the world, the panic spread. The fall of Lehman Brothers wasn't just an American tragedy. It was the spark that ignited a global firestorm. Within days, financial markets around the world went into freefall. Banks in Europe, Asia, and South America suddenly realized they were holding the same toxic assets: mortgage-backed securities tied to collapsing American homes. Iceland's entire banking system imploded. British banks required emergency nationalization. Germany rushed to protect its savers. And emerging economies saw their capital vanish almost overnight. Global trade slowed dramatically. Credit lines froze across continents. Multinational corporations delayed investments, canceled contracts, and started laying off workers in massive numbers. In just a few months, what had started as a housing correction in the United States had morphed into a synchronized global recession. Factories shut down in China. Exporters in South Korea, Germany, and Brazil saw orders evaporate. Oil prices crashed, commodities plummeted, Entire economies entered survival mode. For the first time in modern history, every major industrial nation was in crisis, all at once. And the fear wasn't just about economic pain, it was about collapse. People around the world asked the same terrifying question: is the global financial system about to break? In the face of collapse, governments scrambled to act. In the United States, the Treasury and the Federal Reserve launched the TARP, the Troubled Asset Relief Program, a $700 billion bailout aimed at rescuing the financial system. The goal? To inject capital into the largest banks, prevent more bankruptcies, and stabilize the markets before the panic became irreversible. But the public was outraged. To many Americans, it looked like Wall Street was being rewarded for reckless behavior, while ordinary people were losing homes, jobs, and retirement savings. Main Street was bleeding, and Washington was bailing out the very institutions that caused the crash. Trust in the system, already fragile, shattered further. The narrative became impossible to ignore. Too big to fail really meant too powerful to punish. Executives kept their bonuses. Banks grew even larger through government-assisted mergers. And yet, millions of Americans were left to navigate the wreckage alone. Foreclosures surged past 6 million. Unemployment soared to 10%. Entire neighborhoods emptied out. Suicides rose. Food banks overflowed. Meanwhile, the Federal Reserve slashed interest rates to near zero and began quantitative easing, a massive bond-buying program designed to flood the economy with money and unfreeze credit. It helped prevent another Great Depression, but it also marked a turning point. From that moment on, the economy was no longer just driven by market forces. It was propped up and shaped by central bank intervention. A new era had begun. But the damage wasn't just financial, it was psychological. People no longer trusted the system. They questioned capitalism. And for the first time in decades, the American dream felt broken. The crisis ended, but the consequences didn't. The financial system stabilized, markets recovered, banks became profitable again. But for ordinary people, something fundamental had changed. Wages stagnated. Housing became unaffordable for an entire generation. Student debt skyrocketed, and wealth concentrated at the top. The richest 1% rebounded fast, even stronger than before. Meanwhile, the middle class shrank, and younger Americans entered adulthood in a world very different from the one their parents knew. A world of gig work instead of stable jobs, of renting instead of owning, of financial anxiety instead of security. And the system that caused the crisis? It was never fully dismantled. It evolved. New names, new tools, but the same core structure, bigger than ever. Today, many still ask, did we really fix the system? Or just patch the cracks? Some believe the bailouts were necessary. Others believe they set a dangerous precedent. But one thing is certain. The 2008 crisis reshaped how an entire generation sees the economy, the government, and their own future. And if you lived through it, or if you're still feeling its effects today, what changed for you? Let us know in the comments below. The 2008 financial crisis didn't begin with a war. It began with confidence, the dangerous kind. The kind that turns risk into routine and warning signs into background noise. It started with the belief that housing prices could only go up, that markets always recover, that complex systems don't fail if they're big enough. But behind the glossy mortgage ads, the AAA ratings, and the booming real estate shows was a slow-moving avalanche of debt, speculation, and denial. And when it collapsed, it didn't just destroy banks. It shattered trust. It exposed a fragile foundation that was sold to the world as unbreakable. Governments acted. Markets healed. But beneath the surface, a new reality took hold. A generation grew up questioning the promises they were given. That hard work guarantees success, that home ownership is achievable, that the system works for everyone. And perhaps the greatest lesson of all, the cost of a crisis isn't just economic, it's generational. It lingers in how we save, spend, vote, and dream. It shapes everything, even if we don't always see it. So if you made it to the end of this story, what's your take? Did the system really change? Did we learn anything lasting? Or are we just living in a more polished version of the same risk? Leave a comment below. Let's open the discussion. What did you think of the video? Did anything surprise you? Did we miss something you consider important? And if you found this story insightful, make sure to like the video, subscribe to the channel, and turn on notifications for more content like this. Thanks for watching.